Welcome back, investors. Jake here. About 2 weeks ago on my channel, I announced I would be shorting the market by buying puts on the QQQ. That is the Nasdaq Index ETF. If you want to get caught up on my short position, check out these two videos right here. But sure enough, as soon as I go full leverage against the Nasdaq, it has 5 consecutive green days in the markets, as generally the market was up pretty decent this week. I'm going to continue to defend my short position for you and explain why I'm not worried and I'm still confident a bigger drop in the market is coming this month. But when we look at the 1 week performance, this is the heat map on Finviz.com. Kudos to anybody holding Apple, swing trading it perhaps, up 7% this week. Google up 9, Amazon up 8, Tesla up 11. There was a slight rotation out of energy and gas. We'll explain why. And perhaps as people were selling some of their energy stocks, they went back into tech. However, when we zoom out and look at the one month performance, we're seeing more red. When we look at the 3-month performance, we're seeing the bigger picture of the market is in a steep decline currently. However, for a 5-day performance, after I bought all these puts on the QQQ, the Nasdaq was up 5.9%. So potentially, what was the good news that the market liked this week? And we can look to the payroll increases of 372,000 jobs in the month of June. This brings the official unemployment rate down to 3.6%, and that's pretty low. So this actually gives decent cover to Fed Chairman Jerome Powell to continue raising interest rates, as the labor market is still pretty strong. If anybody, for whatever reason, is laid off from their job, there's still lots of job openings out there. And bigger picture, potentially, what is happening is we're just continuing to see a decline in labor force participation. Despite how many jobs are being added to the economy every month, there's still net more people leaving the labor market than participating in it. So here is the Fed's tracker for labor force participation. And going all the way back to the 1960s, you can see that labor force participation, which is people ages, I think, 15 and older, working a job of some kind, labor force participation started increasing in the 60s, 70s, and 80s as more and more women went into the workforce, creating dual household incomes. Labor force participation basically peaked in 2000 prior to the dot-com crash. It then started sliding in the 2000s, and then after 2008, more and more people just permanently started leaving the labor force. And what's happening here is the baby boomers are retiring. As a percentage of the United States' population, the baby boomers are the biggest generation. Both of my parents are baby boomers. Each of them were one of 6 children. So you can see a slight bulge between the people of ages 55 and 70. This is the baby boomers. However, the generation that came after them, this is the Gen Xers, they're actually a smaller percentage of the population. So what's happening is, as baby boomers more and more reach the age of 62 to 67 and they can start collecting Social Security, more and more of them are just retiring and checking out and choosing not to participate in the labor force anymore. So this actually is beneficial if the Fed is tightening, perhaps the economy is retracting, net the economy is losing jobs, but if more people are leaving the labor force than jobs lost, it's actually pretty decent for the rest of us who still have to work. Another good news for the markets is the price of crude oil perhaps maybe peaked. Oil per barrel peaked on this is June 7th at $122 a barrel. The price has been coming down, which is why I told you there was a small rotation out of energy stocks back into perhaps tech stocks. However, I'm still confident July is not going to be a good month for the market, and we'll just recap all the events occurring this month that could potentially lead to a flash crash or a panic sell or something to spook the markets. First up is the Fed is meeting again July 26th and 27th. More than likely, they are going to announce another 75 basis point rate hike to get inflation under control. The reason why is we're going to get the CPI numbers, the Consumer Price Index inflation data. This will be released on July 13th. Labor costs and energy costs were still spiking in June, so this will be the June numbers, even though perhaps once we get the July numbers in August, it'll start looking a little bit better. Additionally, July 28th, we're going to get the quarter 2 GDP numbers, and this is when we will officially know if the United States economy is in recession, 2 consecutive quarters of negative GDP contraction. So it's coming, scary headlines. Officially, we'll know if we're in a recession. Next up, also this coming week is the bank stocks. All the banks will be reporting their earnings. JP Morgan, which is the largest bank, is reporting on July 14th. So once again, indications of how the economy is doing, how strong are consumers' checkbook balances. We'll know this next week. And then as far as FANG stocks or technology stocks, Netflix always seems to want to go first. They report the week after. This is July 19th. And I already know it's not going to be good news for Netflix. Despite the popularity of Stranger Things Season 4, it's not really helping them. Netflix was projecting to lose an additional 2 million subscribers this quarter. However, according to analysts, that number is going to be closer to 2.8 million subscribers. So potentially they're losing 800,000 more customers than the 2 million that they were anticipating. However, the valuations for Netflix have already come down so far. I don't see the stock dropping significantly more, but it's just definitely not going up in the up direction anytime soon. So here is the 5-year chart for the S&P 500 index. I show you this in every video. I'm very confident that at some point this year, the S&P will get under the 200-week moving average. This is the last technical barrier that trading algorithms, large funds, technical traders are looking at. So the 200-week moving average currently is 3,517. Each one of these candles represents a week, and I'm feeling over the next 3 or 4 weeks, we might actually slice below this 200-week moving average. So here it is. Here's my Schwab account, and I want to show you the damage and then explain to you why I'm not too concerned. So when you look at my cost basis for all of these puts on the QQQ, it totals about $15,000. And because the Nasdaq was up almost 6% this week, with options, you really get punished. So the expiration date for all of these puts is in September. I still have plenty of time to recover if the market experiences another sell-off. I still stand to gain a lot of money if I am right about my investing thesis. But for this week, in the short term, it stings. These contracts down 34%, down 46, down 34, down 19. But I'm still so confident that if, let's say, the market is green next week on Monday and Tuesday, then I'm going to liquidate my shares of Aero Environment and buy more puts on the QQQ. So why am I so confident? And let's first look at the S&P 500 index, which once again, I don't expect to fall as dramatically as it contains defensive stocks, utilities, energy stocks, healthcare stocks, much more stable. They're not going to fall as hard as potentially high growth tech stocks. But with the S&P 500, we've been stuck in this channel, this range, going all the way back to December of last year. So this is going on 7 months. And the bottom end of this channel has 1, 2, 3, 4, 5 points of contact as we're continuously making lower lows within this channel. Now, what is the upper end of this channel? That's debatable where you want to draw this line. It's not so clear on the upper end. But this level of broad support for the entire market for the S&P at around 3,900, it held on May 12th, it held again on May 19th and 20th. We then completely sliced through it with a flash crash. This was early June. The market made it to the bottom end of this channel, and then we saw buyer support. Look at this volume of trading as buyers stepped in at the bottom end of the range. It then recovered to the previous level of support. So often with technical analysis, prior levels of support become new levels of resistance. It bounced off 3,900, and yes, we had 5 green candles this week. It was a good week for the market, but we didn't get above this previous level of support, previous level of resistance, and we're nowhere near creating a higher high. How do I lose money on my trade? And I lose money if I'm completely wrong, and this right here was the bottom of the market, the best opportunity to buy in at the lowest cost. If the market just goes straight up over the next 3 or 4 months, then my Schwab account is going to zero. Thanks for playing. I lose everything. But with rising interest rates, the war continuing, inflation still being pretty bad, I just don't see this channel not continuing at least through September or October. This line right here is this green line down here is that 200-week moving average. And if the channel holds, the S&P will be probably around 3,400 by September. But the QQQ is going to fall harder than the S&P if there is a panic sell. So here is the channel on TradingView for the QQQ. We've been locked in this downtrend for the Nasdaq since early November, and it's basically just a little bit steeper than the S&P. However, this channel, you can see it right here, the Nasdaq is knocking on the top of it. And where you want to draw this upper line, it's debatable. However, the bottom end of this channel is much more solid. So if we do experience a sell-off in tech stocks again, where is the QQQ going? And I could easily see it getting back down to the bottom end of this range with a value of about 250. If the QQQ can sell off over the next 3 or 4 weeks back to 250, once again my contracts expire in September, then all of these contracts are in the money. They're all going to make me a lot of value. We'll see what I do with them if the market does sell off. So how can I be so confident that the QQQ, the Nasdaq, is going to continue selling off? And this is the part of the video where I might upset some people, because I know these are very popular stocks and lots of people are owning them, going long, dollar cost averaging in, buying more. But I'm sorry, over the next two or 3 months, I think these are going lower. So here is the top 10 holdings of the Nasdaq, of the QQQ. Apple is 12.7% of the entire Nasdaq index. It's huge. Microsoft is 10.8%. Amazon is 6.3%. Tesla is 4%. Alphabet, between their Class A and Class C shares, is about 7.8%. Meta is 3.1%. Nvidia is 3%. PepsiCo is 2.1%. Costco is 1.9%. So even though with the Nasdaq it is mostly tech stocks, there still are consumer discretionary stocks like Pepsi or consumer staples like Costco, or whatever Costco is classified as. So potentially, if the QQQ is going down, some of these stocks have to continue going down. And when you add up the 10 largest holdings, this equals 52% of the Nasdaq. A majority of the Nasdaq index, the QQQ index ETF, is just these 9 companies, because Alphabet technically takes up 2 of the largest 10 holdings. So if the QQQ is going down, that means Apple has to go down. So let's go on macrotrends.net and look at the price to sales ratio of Apple. Price to sales, in my opinion, is the purest form to see whether or not a company potentially might be in a bubble, potentially might be overvalued. Because not every company has earnings, not every company has positive free cash flow, but ideally every company at least is bringing in revenue. So the historic valuation for Apple, their price to sales for the longest time was between 2 and 4. Now, if a company is growing faster, it deserves a higher price to sales ratio. But Apple's price to sales maintained this valuation between 2 and 4 all the way up until the year 2019. If we're going to argue that the market is currently in a bubble, currently deflating, then I think the valuations of companies really started to become unrealistic at about this time in 2019. So Apple's price to sales ratio spiked up to 7.7, even got as high as 7.8 when the entire market peaked 6 months ago. The price to sales multiple has been contracting, but the question is, if we're heading into a recession, a global recession, then we're going to have not only multiple compression, but also price to earnings and price to sales compression if the revenue of the company isn't increasing as much or, heaven forbid, actually decreases. So I easily can see Apple's price to sales ratio falling to back down to a historic valuation closer to 4 or 5. So if the price to sales of Apple is going back to 4, then Apple's share price has to fall by about a third. So here is the chart for Apple on TradingView. Once again, it's currently just bouncing up and down in this range between about 130, 132. However, there's a upper limit here at 150. So I think Apple potentially could hit this 150, sell off, and start going down. Where is a level of support if it falls below this previous low and creates a new lower low? Apple's probably going to go to 120. But if Apple's price to sales is going to fall to 4, then it needs to lose a third of its value. So Apple potentially is going to fall, before this is all over, back down to about $100 a share. Now they're giving their earnings on July 28th. This is going to be a very important day. Apple is such a heavy weight in all the indexes that a sell-off in Apple usually triggers off a sell-off in every single stock. So with QQQ, looking at their holdings once again, Apple is 12% of the fund. And if Apple alone is going to sell off by a third, then that's 4 percentage points for the QQQ being lost right there just on Apple. That is alarming to think about. Once again, this is going to be the unpopular part of this video. Let's now go to Microsoft, and for the longest time, Microsoft, their price to sales ratio was between 2 and 5, but as their business, their entire model really started to improve once they moved to a subscription service rather than selling CDs of Microsoft Office. They've also got Microsoft Azure as they go into cloud computing. Microsoft has really been picking it up the last 5 or 6 years. But do they deserve a price to sales ratio of 13? That is where they were when the market peaked 6 months ago. So currently, multiple compression for Microsoft is occurring as the multiple for price to sales has come down from 13.7 to 10.5, but this is still more than double what their historic valuation for the longest time was. What is a reasonable price to sales multiple for Microsoft in a global recession? And it could easily be back down to 5. So if it's currently at 10.5 and it needs to come down in half, then Microsoft, which is currently their share price today is at 267, Microsoft could potentially fall to 130. In the short term, just looking at the technicals, there's a level of support at 245, a level of resistance at 275. It could have another couple green days, get to this upper limit. The sellers will step in. It'll bounce back down to 245. But if Microsoft is going to fall in half and it's 10.8% of the funds, then the QQQ could sell off by 5.4% just because of Microsoft alone. That's without thinking about or talking about any of these other stocks. You can go through a lot of these companies. I think Meta has already exhausted itself and sold off enough. Amazon probably has exhausted itself and sold off enough. But other companies such as Tesla, Alphabet, Costco, Nvidia, when you look at their historic valuations for their multiples compared to where they are even after selling off, they still have a long ways to go. So that's my investing thesis and why I'm still confident about all of my put positions. Once again, if the market is green on Monday or Tuesday, I'm going to liquidate these shares of Aero Environment and just buy more puts on the QQQ. Okay, everyone, that's all for this update video. If you want to tell me I'm an idiot and I'm going to lose all my money, it's possible. It's definitely possible if, 2 weeks ago was the very bottom of the market and I perfectly mistimed it. We'll find out together. I'll keep making these weekly update videos. If my account explodes and doubles up, I'll be pretty happy that day, but I'll make that video for you as well. Until the next video, guys, take care.